Hello, everyone, and welcome to RealAlt Investments live events hosted by Six. This is the first of a five-part series with Six. We really appreciate all of you joining us today. I know it's a little different content than we typically air, but real estate and real estate investing is always top of mind in the Canadian market, so we're very pleased that you were able to join us today. I'm more pleased to introduce RealAlt's external advisor and general Canadian real estate expert, Peter Friedmann. So before we get started with anything else, Peter, can you tell us a little bit about your background? We take it from your team that you're an expert in all things housing, so I'd love to hear what that means.
Okay, thanks, Romeo. I've been more than 45 years in housing and economic analysis, and that's provided me lots of understanding and opportunities to explore the markets. But 37 of those years was at Canada Mortgage and Housing Corporation, the federal agency responsible for housing. My background included market analysis, economics, actuarial work, financial forecasting, housing policy, mortgage insurance, securitization leadership, federal provincial housing programs, Indigenous housing, research and sustainability. So when you say all things housing, I think that's about all things housing. The key accomplishments over that period, I established the market analysis profession at CMHC. It wasn't existing in the 80s. I started it up in 81. Improved the national housing surveys. So they were hit and miss, so we made a comprehensive revamp of all the housing surveys, which feed all the data for all the decision makers in the private and public sectors. I established part of the team that established mortgage-backed securities in the mid-'80s in Canada. And then we did a revamp in 1999-2000 and established the Canada Mortgage Bond. So the securitization market, very important to the funding on the residential real estate, and we are the backbone of that. The first-time buyer program, introducing 95% lending, was introduced under my watch. The liquidity relief program, which was the mortgage purchase program done during the financial crisis, where we helped out the financial institutions avert a liquidity crisis by buying back $69 billion of mortgage-backed securities. That came off without a hitch, was a big success. The federal provincial affordable housing program agreements. I did those in a couple provinces, BC and Ontario, but I did the last three in Ontario in the early 2000s. And working through three recessions has taught me a lot about housing, the economy, and how you have to operate. Since retiring from CMHC, my work has focused on strategy, risk, and governance for housing, including nonprofits, private, for-profit companies, and publicly listed companies. So that's my background. Sorry, you're on mute.
Thanks. I appreciate that, Peter. And you've got a couple recessions on me, so that's extra experience we appreciate. But I'll start with the big question. Can you tell us what's happening in the Canadian economy right now, and what that impact on housing is really going to be?
Well, we can see the economy is slowing down, and that was predicted. Everybody predicted that would happen because of the rise in the interest rates. What you have happening is typically when interest rates start rising, you have a 4 to 6 quarter lag in the effect on the housing and the economy. Now they started back about 5 to 6 quarters ago, so what we're seeing is exactly what was expected. Last month, I believe we had a GDP decline. This month, probably the same. And I would expect we're going to see that for another 1 or 2 quarters. A lot of people thought we might not have a recession, have a soft landing and all that, which would have been fine. But there's not much difference between a soft landing scuttling around 0.1% growth versus being at minus 0.1 or minus 0.2. The difference is, you're touching down. We're on the start of a long runway. I think it's going to be a flat road ahead. The housing market is equally tepid, and I don't think there's any quick burst of activity that's going to happen. We're into slowly rebuilding both the economy and the housing markets. Now, with respect to housing, sales to listings ratio, sales to new listings, has that's a standard indicator for residential anyway, and it's returned to what's called a balanced market. For a long time, it was in seller's market territory, where the sellers could ask what they want and get a house sale within a couple hours. It's no longer the case. What you're finding is now that people have a chance to think, have a chance to check out whether they can afford it, have a chance to check out the competition, don't feel rushed into a decision, and can make the prudent choice. Buyers are cautious. Builders are also cautious, but both of those things are a result of the interest rates being higher. So in general, the economy is slowing down. It's going to be that way for a little bit. Housing has slowed down, and we'll have more to say later in the interview with respect to what's coming. But I don't see any rapid rise similar to what happened in 2008-9 after the financial crisis.
Now that's my next question. So I hear slowdown and caution. Obviously, some of us have a bit of trauma from 2008. I was only 20, but I certainly still remember it. So I'd love to hear your perspective on whether this parallels that period, the ways in which it's similar, the ways in which it's different.
Okay. So I don't believe it's similar at all. It's different. That crisis was brought on by illiquidity, which happened at a global scale. And that was precipitated by the mortgage-backed securities instruments and all the derivatives that were invented around them in the US. That spread rapidly across the globe as those assets were repriced and hurt many institutions, pension funds, and institutional investors. What we learned from that crisis was the need for global standards on risk for financial institutions, and many improvements were undertaken quickly and adopted. Those improvements included identifying financial institutions at risk and dealing with them early in order to avoid the multiplied effect when the contaminant spreads throughout the whole industry. And we saw recently how that happened again, just earlier this year with a couple banks going sideways and going down, and they dealt with it. They contained it. In Canada, we performed very well during 2008. Many of our practices, which we have undertaken all along, have become the benchmark for what other countries have done moving forward. The current slowdown actually reminds me of the one of the early 90s, when after a period of rapid housing price appreciation, the economy went into a recession. That was a deeper recession that lasted longer, and it was a very slow recovery. Many who were around will remember that the prices that they might have paid in 1989, those prices didn't recover until about 1999. So it was a long dip and a slow rise up. The difference today is that we're experiencing dramatic population growth, and that continues to fuel the market. And this primarily as an effect of the immigration targets being raised and people coming to the country. Employment growth, however, is slowing a bit, and unemployment rates are rising. Yet there are real wage increases. We've heard about the settlements happening. Those are really in reaction to the inflation that occurred last year and the large profit margins that some companies had. And workers simply were striking for the purpose of, we want our share of that, because we've been suffering with no wage increases and high inflation. The other thing that's different is temporary workers and international students. It's such a dominant part of A, the labor force, and B, the market right now. It wasn't that way in the 90s. I understand from reading some articles recently that the number of international students in Canada is, as an absolute number, higher than any other G7 country in the world. So we don't realize how many foreign students are here, but that's the facts. So this one, not like 2008, it's like 1990, and it's a slow road back.
Oh, interesting. And one thing I noticed, I think a lot of people notice, is there seems to be, and this was never the case before, almost daily updates about housing from every angle. You get it from levels of government, from the media, et cetera. Why do you think it's suddenly become the issue du jour across the board?
Well, it's headlines.
Mm.
And every politician is scrambling to offer solutions to the affordable housing issue, whether it be rental or home ownership. In fact, they can't point fingers anymore because everyone has a piece of this: federal, provincial, municipal. And so they want to now work together as opposed to be at cross purposes. Recently, CMHC updated its analysis on housing shortages. That was done a year ago. They just updated it. It still shows their forecast that we're about 3.5 million houses short of where we should be to reestablish affordability in Canada. For Ontario, it's about 1.5 million short. And so that means that if you had an additional 1.5 million houses in Ontario, in addition to the, say, 1.1 that have to be built, so 2.6 million in the next 6-7 years, you would have sufficient supply to take all the heat out of the market and rapid appreciation in prices and rents and everything else, and things would become more affordable. Is it likely to happen? No. We can't build that fast if we tried.
Mm.
But anyway, there's divergent views on what this means in Ontario. Some would suggest we have an extreme shortage in supply and too many regulations and obstacles that prevent building quickly. Others, including the people who are the professional planners, they would suggest Ontario has an adequate supply of housing and there's no need to take land from the Greenbelt, for example. Now, I'm not going to go there and talk about that issue. It's more political than anything else. But so there's enough supply questions out there that, again, it's almost like we have to do it, they have to do it, who does it? Federally, they announced the Housing Accelerator Program, which is designed to help municipalities reach their affordable housing goals by providing them additional dollars and grants and the like to streamline their approvals process and incent the municipalities financially to improve on their turnarounds. Ontario has offered incentives to municipalities that reach or exceed their targets for affordable housing by giving them extra dollars or rewards for doing so. So they're trying to be encouraging as possible. Newly announced just last week was the elimination of the GST for new rental construction, which was matched in Ontario with the elimination of the PST. So basically, you got 13% coming off the top on construction costs and labor costs now as they're trying to develop new rental affordable housing. I think the development community will welcome these changes, and they say this will stimulate rental construction immediately. And then there was, I think the most recent Ford Fest was held in Kitchener-Waterloo a week ago, and Doug Ford announced that he wants to see housing that's affordable for everybody. He wants to see houses that are built, whether they be modular or component housing, but built. And he said these should have a basement, finished for rentals. They should have a fenced backyard and a paved driveway for $500,000. I thought that's fantastic, but that must presume a lot of things to happen. I could see it could be technically feasible if it was done on leased land and you took the whole land out of the equation. So a municipality could own the land and put a 99-year lease on it, allow somebody to put a house on it and live there with security of tenure with a 99-year lease. You'd also have to look at permit fees, development charges, and all these things because they're about 30% of the cost of a build now. So in reality, municipalities, regardless of this promise by Doug Ford, municipalities really can step up here. They can do a lot to deal with affordable housing. Many are looking at increased density along rapid transit lines. Many are waiving development charges for affordable housing. Many are looking at how we can get more basement suites legalized to add additional rental stock. So in order to have a solution here, you have the federal and provincial governments trying to add incentives or maybe dollars in the big picture, but really the action has to occur at municipalities. And I think most of them will be taking a very close look at what they can do to both speed up their approval process, streamline it, and in fact, maybe eliminate some of those charges that are adding to costs to construction.
No, I appreciate that. And just before I move on, I want to let people know, especially the cohort that popped in late, that you can access the chat in the bottom right of the screen, and that'll allow you to ask questions. So you can get them answered in real time by a real estate expert. Getting back, Peter, you mentioned earlier, about the really remarkable rate of foreign students in Canada, et cetera. Can you more broadly give us your perspective on immigration and housing, how that's likely to impact it over the next short, medium term?
Well, immigration targets have risen fairly rapidly over the past 4 or 5 years, and they're close to 500,000 now per year. And these targets, I think, are planned to continue till the mid-2020s, and then they may revert back to what they were. The idea was that we need more immigrants in Canada to satisfy our population needs. We're an aging population. And we have been not reaching our replacement fertility rates since, I think it's about 1972. So basically, demographically speaking, every family should be having about 2.1 children in order to replace themselves. And we've been hovering around 1.5, 1.4, even lower. And there's so many single person households now. It's a very dominant form of households in Canada, the recent census has told us. So we have an aging population, and we have people who are leaving the workforce because of age, and we don't have enough workers to satisfy it. So that's where the temporary foreign workers comes in, but also immigration comes in. With the permanent immigration, they're looking at skilled immigrants to bolster our capacity for change and for productivity. And it could be in areas of science or technology. It also could be in areas of medicine and things. But many are asking, why aren't you doing the same thing for trades? If you're not educating enough people in Canada, why aren't you bringing trades in? Because we've all heard about trade shortages. So absolutely, immigration affects housing and it affects the economy. With respect to the student populations, that's very interesting because if you think about it, many of the students have already been here for a couple of years. They might be in third year, fourth year. They might be finishing college and updating themselves at university or vice versa. So they're really not affecting housing demand because they're already here. What you have to look at is the net new influx that's coming in every year. And is that substantial? Recently, there's been some press about how the whole number of international students and temporary foreign workers has been underrepresented in the data by perhaps 1 million people. So that's significant when you think about where all those people are living and what the impact on social services or jobs or anything else is. You will find that many, for example, students probably live 4, 5, and 6 people to a unit, which is different than a typical Canadian student or a Canadian standard. But that's what they're having to do to get by. They're also having to find part-time jobs or several part-time jobs to pay for their education. Their education is much more expensive than if you were a domestic student. So those are the things that are happening in the background. But certainly in terms of what's coming in the future, I don't think that anybody's talking about slowing down the number of foreign students. Colleges and universities depend on it. They depend on the revenue, additional revenue from it. But students also are almost a special category when it comes to immigration, because if you're in the country already, you've kind of jumped the queue in terms of becoming a permanent resident or a citizen, or bringing your family to support you or vice versa. So I think if you look around the world, we probably have one of the most generous programs for letting students become permanent residents and staying in the country. And I think around the world they're noticing that. That's why we have perhaps the largest absolute number of international students. So what's going to happen with respect to the normal terms of immigration that happen? In Ontario, you generally get between 35 and 40% of international immigration, at least. So you're looking at, 150 to 200,000 immigrants a year. Well, by definition, if you're dealing with a household size of 3, that's an additional 50,000 units. If you're, 50 to 60,000 units. So we just can't keep up. And that's why everybody's jumping up and down about removing barriers and getting stuff going faster. They don't think that the supply is enough. On the other hand, when I look at the aging population and when I look at the housing markets, I look for fundamentals. What is the long term on this? Because housing shouldn't be a quick flip and move on and do all that other stuff. It really relates to what is it grounded in. So housing is unique in that it has both a shelter and an investment motive. When I was growing up, the motive was almost entirely shelter. It became more investment related. And I would say in the last 10, 15 years, and the investment motive almost dominated the reason for housing, with people getting into the market, fear of missing out, trying to make quick flips, renovation TV, as I call it. Anybody can go and buy a house and fix it and flip it. I mean, that sort of nonsense is, and I call it nonsense because it's not practical. It is not fundamental to the economy. It's not fundamental to what drives housing demand. So I think if you focus on that, what you understand about immigration is you need it because all the people who are in Canada are aging, and there's going to be a greater dependence ratio on the people who are left working. And if you don't have sufficient workers, you won't have an economy that's strong enough or enough people paying taxes to afford the social services that are needed. And I should say that many countries look with envy at what Canada's been able to do with immigration because they're suffering the same consequences. The whole world is aging in the same pattern, and birth rates have fallen almost everywhere. So a lot of countries are coming to grips with this. We happen to have a program that is working pretty well. Maybe locally people don't think it's working well, but it is.
No, that's a good perspective. I got one just jumping into the questions right now, just because there's one directly related. Kendall asks, are they making the immigration processes faster right now? And you anticipate that to have an impact on house prices?
Well, whether it has an impact on house prices, I don't know. But if they can make it faster, it can make it smoother for the economy to react. We did hear about there's so many job openings and we can't fill these jobs. In fact, what's happened in the last couple quarters is the number of job vacancies has fallen and unemployment has gone up. I would suggest that the number of international students and temporary workers are filling way more jobs than you would anticipate. When you hear the stories about typical students having 2 part-time jobs, well, those are 2 part-time jobs the Canadians wouldn't take. So, I mean, it is filling a huge gap. Is it going to contribute to housing prices? Not sure because the temporary worker foreign students, they're not typically buying. It's a question of whether skilled immigrants come and where they go. I know I've seen studies in the past that say the immigrant population tends to move into home ownership faster than the Canadian population. So while typical Canadian household might take 7 to 12 years to move into home ownership, an immigrant household takes about 5 years. Perhaps it's because when they come to Canada, they are co-housed with other relatives or something else, and they're just saving immensely and trying to establish their own foothold, and then that would also allow them to bring in other relatives in the same sort of manner. But eventually, certainly, immigration will contribute to housing demand, home ownership demand for sure, and prices. That's why I think this recession is perhaps different than most we've seen. Fundamentally, there's an underlying fuel to the whole process with immigrant demand.
Yeah, no, I appreciate that. Let's get into the numbers now. So we're looking at interest rates. So we've seen over the last 11 months, I believe, a rise from 1.5 just percent to 5%. I don't believe that's happened any other time during my lifetime. I'd love to know, just is that unheard of, and what's the impact they're going to be?
Well, is it unheard of? Interest rates, for some of us who were around during the recession in 80 to 82, will remember when mortgage rates peaked at 21.5%. So, yes, they went up rapidly then too. But what's different is the Bank of Canada has a policy on how they set rates, and that program has been around since the 1930s, but it's changed several times, and most recently changed in 2001. So to say comparatively this never happened before, since 2001, it's never happened before. But prior to that, it could have, but it would have happened in a different way. Most would say, okay, what's going to happen next with interest rates? And yesterday, I think it was yesterday, inflation came out at 4%. And so people are all concerned, okay, that's turned the dial. They're going to up rates again. I think what's happening is, again, the inflation in this case was largely based on the rapid rise in gasoline and fuel prices, as well as home ownership costs, mortgage costs. They're up 30% year over year. Rental costs went up another percent, and food is actually coming down. They say the core inflation, which is what Bank of Canada looks at, is kind of sticky around 4%, but it isn't on an incline. So I would treat that data as one piece of data. Let's wait and see what happens next. And the Bank of Canada doesn't set interest rates again until I think it's October 25th or 26th, late in the month. And by then, they will have new data on the GDP and what's happening. If it's still in a slowdown mode, they'll have new numbers on employment and unemployment. They'll have another set of numbers on inflation. And they'll also have numbers on trade surpluses and things like that, which matter. Tiff Macklin has been pretty clear about that. We're going to be data-driven. We're going to look at this, and we're going to react if we have to. Why they say that, by the way, is that in that recession I talked about in the 80s, they didn't react properly. In fact, they took their foot off the brake and eased off. And what happened was inflation became surging back, and it was combined with high unemployment, and that's where you had that stagflation term coming into play. And so you had all sorts of problems for the economy for the next 4 or 5 years afterwards. So they do not want that to happen again. And I think it's happening all around the world. Every central banker remembers what happened then. They have a long memory. And so that's why this notion about not acting too soon is and taking a side of caution to make sure it's happening before they move forward. They realize it's painful, but they feel they have to do it. And by the way, politicians, although they might be vocal about it, are happy they don't have to make that decision because it's not a popular decision. So it's better to have that independent central bank making the decision.
I appreciate that. I'm glad central bankers have not just memories, but put them to use. That's always comforting to hear. So, yeah, I mean, you mentioned that inflation is up again in August to 4%. Not to pin you down an answer on it, but I know our investors are interested. Really, what do you think is the likelihood of another increase in interest rates when they do that? I think you said late October, late November rate change.
Well, the swap market, which tries to anticipate that stuff, has priced in about a 40% probability of the rate going up.
Hmm.
Prior to this, so the people who are playing with the money markets are saying, it's probably doubled the possibility of it happening. My own feeling is I don't think it'll happen
Hmm.
because I think the fundamentals aren't strong. And I think another month's data on the employment levels, unemployment, the GDP, and things like that will show that, you know what, this is grinding slower and slower. And if we add another quarter point to this, it'll even be worse. Just look what had happened when they went on their pause and then they reintroduced a quarter in June and July. The June was a shock, July less so, but it caused a complete stall again in the markets, the housing markets. And so uh, housing and housing construction was one of the driving forces of the economy. Take that in consumer spending, and you had the lion's share of what the economy was driven by. So you've got consumer spending slowing down for sure.
Hmm.
The discretionary spending, the necessary spending, food and stuff like that, you still do. But even on food, sit down meals at restaurants have declined a lot. Even the takeout stuff's declined a lot. So consumers are checking their wallets because they know what's coming, and some of them are going to be facing a mortgage renewal, and they know what's going to happen. So they might have several $100s more that they need to find in order to keep their mortgage current. As a result, I think the effect of those high interest rates, the drop in demand by the consumer, and also the slowdown that's happened in construction is going to mean less reason for the bank to raise again. They might, but it just doesn't feel right to me.
Well, appreciate that. And as somebody whose personal discretionary spending has certainly dropped, I notice it too. And there's a lot of personal kind of questions in the chat that we'll get to. But to kind of summarize before we get to that, really, what's your view on what we can expect for housing prices? Are they going to go back all the way down to a level that we saw in 2018, 2019? What looks like where that trend is going?
Well, I think the current MLS house price index is around 140, maybe 139, 140 nationally. It peaked in 2022 in the spring at about just under 160. So it's off about 20 points. I had, when in fact all the people at RealAlt asked me, I said, I'm expecting a 25 to 30% drop. And they said, really? You think it's going to be that much? I said, yes. And will it go further than that? I said, no. So if it's already dropped 20, I could see another 5 to 10% drop easily, but I don't see it beyond that. Now, when you compare it to 2018-19, well, that's when the index was at 100. So you're still like 40 points above what 2018-19 was. So there was an awful rapid rise that was, again, probably fueled by fear of missing out more than anything else, that investment motive as opposed to the shelter motive. And recently there's been a haircut taken by people, and it's largely caused by the interest rates. And I don't think there's much more to come on that. Again, my belief would be that the fundamentals are strong, with immigration levels high, the population growth is there, demand for housing is high. It's simply trying to keep that in a balanced market such that either the seller or the buyer don't have a dominant hand, but it carries on. And if it carries on, it could drop another 5 to 10%, but that'll be the bottom, and then we'll be on. I know there's been some doom and gloom forecasts by some folks saying, oh, it's going to fall way back to that. I don't think so. I mean, there's enough demand that if prices started falling that fast, you would have a couple things happen. I think some of those immigrant households that are bunking up with other families would go say that here's an opportunity, let's go. I also think that the investors sitting on the sideline would say, here's an opportunity, let's go. And when you compare it to what the long-run investment potential is on some of the other asset classes, real estate still holds up quite well.
Oh, appreciate that very much. So that's to the end of my questions, but I know we've had quite a number come in on chat. Just a reminder, if you want to throw them in the chat in the bottom right, we'll try to get them today. But if we can't, we'll make sure that the team from RealAlt gets back to you with any answers to specific questions that you've got. I want to get into a couple of them right now. So Abby asked right at the top of the presentation, and you've kind of gone over it, but just to ask for posterity, and this is also kind of a specific local market. She wants to know what the anticipated bottom for house prices is in Ontario, particularly Toronto, and how you suggest that people like her approach the market today.
Well, if this is her first house, I would say I would approach it for, this is how I would guide myself. I'd say, do I need it to live in? Shelter. Yeah, investment is nice, but do I need it to live in? If you need it to live in and you're happy with that neighborhood and you're happy with that housing unit, then you're going to be there for 5 or 10 or more years. And if there is any further price declines, it'll ease out and return and be back up to where it may be there and then some. So even people who were buying in the 90s, the last time something of a protracted recession took place, people were buying in 91 and 92. Prices were still falling. They fell till about 93. So if you would have bought in, I think it was the third quarter of 93 or early 94, that was the very bottom. And then you just had steady rise in prices. So for a person who's contemplating it today, I would simply say, A, can I afford it? B, is it a place I'd like to stay? Because don't plan on flipping it and moving quickly. The transaction costs in real estate are high. So if there's not rapid price appreciation to help you pay for that, you're going to be paying for it out of pocket. So if you have a secure employment and you're thinking that you're going to stay around that neighborhood or whatever you're doing, and you're ready to do that, and the shelter is attractive to you, then it's a good time to do it. I wouldn't shy away from it. If all of a sudden we reach bottom and the media gets a hold of that, there's going to be a frenzy. Unfortunate, but too many decisions are made based on media headlines. I hate media headlines because you get about 10 seconds of information, and that creates your own impression and influences your decision, and it shouldn't. Do the research, take a look at the underlying market, say what's the long run on it, because I'm making a long run decision on residential investment, but more importantly, I'm making a long-term decision on where I want to live with my family. And if you're happy with that, you can ride out whatever's happening.
I appreciate that. I think your anti-flipping stance might have the HGTV marketers come after you, but certainly appreciate it. I got one question. I mentioned before that this came in on email as well, but there's a live question that came in. P.T. Harris is asking, is my money in infrastructure and office REITs or EITs a lost cause at this point?
I don't express to be an expert in infrastructure, office, or those sort of REITs. In fact, I've never invested in them because I'm not an expert. If I don't understand it completely, I wouldn't go there. But you look at the dynamic forces again. What is the long run position on it? So if work from home is here to stay and people don't have to be downtown in that office tower. Where are they going to be? Well, they're going to be looking at a house that has a little office in it that I can use, or I can run a business out of my basement or garage or something else. So I think there's been enough changes going on with work from home, the gig economy, and everything else, that there's a bit of upheaval in that whole office sector. And as a result, I'd be careful. With respect to infrastructure, I mean, infrastructure is one of those must-haves. We used to always think about them as roads and bridges. It's beyond that. If you think of telecommunication infrastructure, whether it be satellites or high-speed internet to everywhere, I mean, this is a reasonable business, and it has reasonable upside. But again, I don't profess expertise there, and I would say do your homework.
That's always good advice. Certainly appreciate it. Nate, again, has really specific personal questions. I answer it, to the best of your ability. But Nate says he renews a mortgage in November and looking for the best strategy. Like says 2-year variable. He says soon we see rates decline late 2024.
One time a guy asked me, what should I do about interest rates? And that's when we were at 21.5%. Because I was an economist, he thought I'd know. And I said, what are you comfortable doing? He says, well, they might even go higher. Maybe I should lock in for 5 years. I said, I'd never lock in at 21.5% for 5 years. There I would go short term. With respect to today, most of the forecast is talking about the earliest that real interest rates will start falling. I shouldn't say real. Earliest that mortgage interest rates will start falling in a substantive way is likely June, July of next year. So initially they talked about this happening later this year or early next. They've pushed it off about 2 quarters, and they're showing that rate reductions will likely occur in the second half of 24 and through 2025. So if that's what your best guess is as well, and you're happy with it, then a 2-year might work. You will find if you look at all the mortgage products out there that even if you did something like take a 5-year mortgage with a fixed term, a fixed rate, most lenders, if you stay with them, will allow you to do something with that. What I mean by that is a 5-year term is exactly what it is. But if you go back to them after 2 or 3 years and say, rates have fallen a lot, could I do a blend and extend? And if you haven't heard of that, all it means is I'll keep the last 2 years I got, but I'd like to lock in for a longer term at the current rates. They're happy to do that because they want a customer and they want a customer to stay. So before you jump into any particular term, find out what else the institution will do about that, about letting you maneuver around in 2 years' time if the situation is such that you want to. And it could be just that rates drop, but it could be that there's other stuff going on in your life. Like you might have just lost your job. You might have been transferred. Anything else could be occurring. So costs are high in the mortgages, and breaking mortgages costs is generally high. But, the variable rates currently, you're paying for them. And the regulators are taking a close look at how variable rates are treated. What I mean by that is many of the financial institutions have had a great proportion of their loan book being variable rate. But there's 2 types of variable rates, at least 2. One is a fixed payment and one's a floating payment. So if you had a variable rate mortgage with a fixed payment, what happened was your payment stayed flat while the rates kept climbing up. All of a sudden, you weren't paying enough to pay off the interest on your mortgage. So what the banks did was they would extend your amortization from maybe 25 years to 30 or 35 years in order to saying, oh, okay, now we brought that payment down to where it should be, so his fixed payment is still working at that level. So variable rates with a fixed payment sometimes can cause unintended consequences like extending your amortization. But the regulators are quite concerned about it, and they went to the banks and said, for that portfolio of loans, we want you to put aside additional capital because we think it's too risky. So they might be cutting back on that too. And again, find out from your bank what they're willing to do, but certainly shop around.
No, appreciate that very much. So Greg Charlton reaches out and he says, it's a bit of a long question, but I'll just read it almost verbatim. He says, you mentioned you think the prices may drop another 5 to 10%, but not more than that. But he asks, what do you say to the fact that household debt's higher than in history and unemployment is rising? Both make affording houses generally at current prices difficult. And he adds kind of a secondary question. He says that some people, firms bought houses for investments and that Airbnb rentals are likely to put them back on the market, which again lowers prices due to excess supply. Just looking for your thoughts on those.
Okay, so I think I've kind of addressed the one about could it be greater than 5 or 10%, because I think the underlying demand will be there, either from new immigrants on coupling with other immigrant families because they've often doubled up, or from, in fact, investors saying, gee, I think it's bottomed out. Here's a chance I can jump in and get something and lock in that price, and they're happy with it. Because rents are very, very high, and making investment somewhat attractive. With respect to Airbnb and changing in rules and everything else that's going on there, in that Toronto election that occurred a while ago, one of the candidates said, I would immediately outlaw Airbnb and make them all go into long-term rental. And that would add 20,000 units of supply to the market. So, in fact, if Airbnb did do something like that, or if there was a drastic change, all it would do is add rental supply. So, are there enough investors to buy it? Or you as an Airbnb quote-unquote owner, why don't you just turn to a 12-month lease and have a rental? So it's a choice you make. I don't think that I have never myself engaged in an Airbnb type investment, but I just don't like the concept of it. Many do, but not me. I'm more of a lock in a long term, make it fundamental, and stick to the decision. How that could influence the market if that many came on the market? It would be a blip for sure, but I don't think it's going to drastically affect prices. There is such a shortage on units available on both the condo, the homeowner, and the rental market that it can't make much of a difference.
No, that's fair. And while we're on stuff politicians say, there's a question from earlier in the presentation. Somebody asked, do you believe that any politician at any level of Canadian politics will be able to build at a rate necessary to meaningfully bring down housing prices? And if so, what's a time frame that might make sense on that?
Meaningfully build. Well, if we believe the numbers from the CMHC study, that you would need an additional 1.5 million in Ontario by 2030, then that means you would need an additional 250,000 a year, or 225,000 a year, on top of the 100 to 110,000 you're building. So it's not possible to bring it down, to build that many, to get units in adequate supply that they're now all affordable. I don't believe. Do I think a politician would find a way of doing it? I would say no. And the reason is because a politician doesn't want to be the one behind the scene who's pushing for decreasing house prices for all the rest of the people who own. They would be unelected so fast it would be unbelievable. And politicians. There was a recent article written on it that many politicians own investment rentals at a higher proportion than the average Canadian. So, will they act with a vested interest, or will they do the right thing? I don't know.
It's hard to tell. One question that came in, speaking of the comparative between Canada and the United States in 2008, the question asker notes that it wasn't as bad in Canada. He wants to know if it's safe to assume that's because we had government backing versus via CMHC. And then he's curious of what risks are there when the government, CMHC, takes on that risk versus private lenders.
Well, in fact, after that crisis, I did a cross-country tour explaining the differences between Canadian and American financial markets, especially securitization, because there was so much misinformation. And I got to tell you, I was managing director of securitization at the time. I used to get many calls a day from investment bankers, predominantly the US and the UK, but from around the world saying, okay, how come your mortgages are any different? Blah, 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 blah. And on they go. They couldn't understand why Canada would not crash. So fundamentally, what happened in the US crisis was you have what I'll call a partitioned industry. You have somebody who's a realtor selling a property, fine. That's similar to Canada. You have somebody who's a mortgage broker originating a mortgage, and you have a separate company who's paid by the transaction underwriting it, and you have a separate company buying those underwritten mortgages. And then you have that company who packages them and sells them to an investment banker who makes MBS out of it. And then they sell it around the world. All this whole chain has a whole bunch of people who are fee for service, and they're incented to create more and more volume. So that underwriting shop, they would be paid even more to produce a higher volume. And people really didn't care about the quality of the loan because they were selling it the next day to a guy who was going to put it together in mortgage-backed securities. And, oh, yeah, we'll add this sort of enhancement to it, a derivative, and make it a safe investment, and off we go. And those investments went around the world. So when that thing crashed and burned, you went, what happened? Well, in Canada, we don't have that. You have banks that stretch from coast to coast to coast. They have thousands of branches. You have a common base to lending across Canada. You have common regulations across Canada. The banks, the credit unions, the trust companies, anybody who is involved in mortgages liked to keep you as a client. And by the way, can I sell you a credit card and an auto loan and something else? They weren't doing it on a spin this transaction basis and off you go. The other thing was the mortgage market's entirely different. We had, by and large, 5-year term mortgages. In the US, they're often 30-year mortgages with a 228 or a 327. So they put a teaser on it for the first 2 or 3 years of maybe 1.5%. But after that 2 or 3 years, it would pop to your contract rate, maybe 5.5 or 6%. So what was happening is all the people were buying in the teaser period, and the moment they were coming up for when their payments was going to escalate by 30 or 40%, the same broker would call them, spin the transaction again and say, by the way, your house is worth more. I can get you more money now, and then you can go buy that boat if you want. So that's where the whole term of using your house as an ATM came from. People were going from teaser rate to teaser rate to teaser rate, taking the highest mortgage they could. And then when the market crashed, they got caught. They were well over their head, and they couldn't refinance any longer. Their teasers came due. Their mortgage costs were going up 40, 50, 100%. And so defaults started to happen. We had none of that in Canada. We had professional people, professional financial institutions, and everybody was doing their job to continue to contribute to a low-risk environment. Now, your second part of the question, is the government taking all that risk? There's private mortgage insurers as well, and the private mortgage insurers are doing the same thing. And if you take a look at what the private mortgage insurers are doing in terms of their own profitability, it's been a very profitable industry. Arrears rates are very low in Canada. They still are. They're at like 0.15 or 16%. In the 90s, the lowest arrears rate you used to see was 0.35, so 2 to 3 times higher. And in some provinces, arrears rates were at like 1% or 1.25%. So that's when an economy is grinding, people are losing their jobs, and all of a sudden you have arrears. We don't have arrears rates even showing up here. And in 2008, it was roughly the same thing. Arrears went up a bit, but not much, because it was a very short-term blip, and then we were back on normal course. So I don't think the government's taking a huge risk on this. It's a private sector business as well. They have actually a majority of the business being underwritten is by private mortgage insurance companies, and they're very, very profitable.
No, thanks, and hope that answers your question, Kendall, that popped in. I got one question for you. Just, our primary audience is mining investors. Noticed a lot of familiar faces and names in the list of registrants. So I'm curious, Peter, do you know anything about mining investing?
Not really. But what I do know is if I don't know something about it, I stay away from it. So I would rely on those mining investors to tell me what to do. But when it comes to real estate expertise, I know that stuff.
Well, in that vein, what would you like to tell us about real estate investing to close off today?
Well, to close off, I'd like to tell you that, in fact, your next session is going to be with a guy called Brian Dorr, and he's going to do a real estate interview, and this guy's an expert. I've known Brian for 30 years. When I hired him to Canada Mortgage and Housing Corporation, he was part of a small team that had a formidable challenge. That was that recession I was telling you about in the early 90s that continued and went along on a long, slow ramp. Well, we had a number of co-op housing projects in difficulty, and they were faltering and they were going to default. So we had to work them out. So this team was assigned the task of saving as many as you can and keeping this thing going. As it turned out, they developed a methodology that was not just a financial methodology, but one where they had to listen to the provincial partners, the municipal partners, the co-op owners, the co-op federation, the federal partners, put together a package that would work for everybody. And how did it turn out? They managed to save every project. So, in fact, what I used to say to Brian is, you guys had a baptism of fire. If there was ever a time to learn about real estate, what to do and what not to do, you joined at the right time and you learned all that. Since that, he went on through CMHC. His career went upwards fast. He went through underwriting of multifamily, single family, default management, real estate, lots of things. And after that, then he went to other agencies, private companies, governments and stuff. I'll let him tell you that story next week. But if there's a guy that I listen to, I probably taught him a few things at the beginning, but he can teach me many things now with his expertise in real estate investing. And stay tuned to next week.
Oh, thank you so much. And thanks generally, Peter, for what honestly was a really great conversation and for your time today. And to everyone who joined us, particularly those who signed in to ask questions. Now, if we didn't get to your questions, and I know we did miss a couple, I'll make sure that RealAlt gets back to you as soon as possible. But if you're like me and you always think of the best possible question to ask the moment the event ends, please do reach out. We can pass those along as well. We do hope very much that you'll join us for RealAlt's next event this time next week with Brian Dorr. But otherwise, have an absolutely lovely Wednesday. And thanks again, Peter, for your time today.
Thank you.